Morning, everyone. Happy early Wednesday morning. For those of you that don't know me, my name is David Mott. I'm an advisor and director of advanced planning here at Nexus One. Giving another quick market update, but a little bit of a special video this time. We're going to talk about some recent changes that were made to the allocation that you may or may not know about. But to jump into the market, I sound like a broken record. The game of ping pong continues. Markets down, S&P 500 just over 2% on the week. When it comes to year to date, floating just over 4%. So again, not real dramatic movements and pullbacks in the market, albeit still down. A little bit of a good news going on as of this morning. Price of oil, given with the conflict over in Iran. West Texas intermediaries down in the mid to upper 80s. Brent went below $100 a barrel. So with that, a little bit of a reprieve. In addition, gold is making up some ground. Again, though, it's still a wait and see when it comes to the situation. A new move that you may or may not be aware of, about 3,000 soldiers from the 82nd Airborne are being called in to support. That's not boots on the ground, but they are getting at the ready. But again, largely no movement. Wall Street is still waiting on some good news or some bad news to break this vicious game of ping pong, a dollar or a point higher, a point lower. On the tech news, we do have a little bit of an interesting piece that came out. Meta, formerly Facebook, has been found guilty for some negligent and not protecting minors in the state of New Mexico. That social media platform, there have been a number of litigation moves across the world and at the state level, not the federal level. There's over 2,000 lawsuits pending when it comes to AI chatbots. Wall Street's trying to digest what kind of parameters and what kind of liability these tech giants are on the hook for as we move through this new tech era and certain nefarious effects happen. How much responsibility falls on these big companies? Again, the settlement relative to Facebook's earnings is very small, but this is the first time that Meta was found guilty. Of course, this will be tied up in appeals. They disagree with the ruling. But what it does is it starts to give us some clarity in terms of tech's responsibilities when it comes to the AI chatbots and the social media platforms. That's really the one nice water cooler news when it comes to tech and your quick market update. But now let's talk about some recent changes we've made here at Nexus One. So a number of you have called in and noticed a number of prospectus pages that were mailed or email notification on that. That is because we made a move on the allocation on the bond side of the portfolio, the fixed income bond side. Now, before you disconnect and stop, I want to lay out, I'm going to make it very elementary on why we did what we did. And for those of you that just want a quick blurb on what changed, you got it. Stay tuned. And for those of you that want more detail, I'll dig in here on this video. In short, though, right around March 17th, March 18th, we did adjust the allocation of the bond portfolio. Again, those of you that are heavy into equities probably didn't even notice this change. It was very subtle, but it's a reallocation when it comes to how those bonds were invested. Historically, they were largely in what's called the Bank of New York aggregate bond market, which is an intermediate bond. Bonds are very susceptible to not only their ratings, their coupon rating, but truthfully, their duration, how long the bond is. The longer the bond, those long-term bonds, those intermediate bonds, respond more volatile to changes in the rates, And so with that, with recent movements in the market, we're noticing that it's more volatility than we care to have in our fixed income. So what we've done is we have moved a portion of the intermediate bonds into short-term bonds to curtail that bouncing. We have also removed the high yield, which I'll speak more of. Again, they act like a stock. They're technically fixed income, but bouncing a little bit more than we like to see in the protection side of our portfolio. And we have also introduced a bit of gold into it. Can you really be a capital preservation firm without a little bit of gold in the portfolio? We have introduced that. So in a sentence, to smooth out the volatility, we have shortened our duration of the bonds, less intermediate, introduced more short-term and ultra short-term to smooth out the ride. Just wanted to let you folks aware on why we did it, what we did, and now let's dig into some of the specifics on these particular moves for those of you like me that like to dig into the details and want to look at a little bit of the technical side. So with the reduction of the intermediate bonds and the introduction of some short-term and ultra short, why did we do that? Why do we want to reduce the duration of the bond? If I can lay it in a sentence, I want you folks to think of a fulcrum for my engineering folks, or a seesaw, if you will. Technically speaking, as interest rates rise, the price or value of that bond decreases, and the vice versa is true. As interest rates lower, the price of the bond increases. And how long that duration is determines how much of that swing is. If we take a look at long-term versus short-term Vanguard funds, if you take a look at right when interest rates started coming into question with the movements in Iran, you'll notice that your short-term bonds barely moved. Very subtle movement in it. Why? It doesn't react as much as a longer duration bonds. Our intermediates moved at a modest pace, but the long-term bonds reacted very, very violently to it. And with that said, we have to ask ourselves, what's the purpose of the bonds? It could be generating income. Our argument to that, though, is if it's truly seeking to generate income, there's better places to make money, such as the market, which our strategy has done since its inception. A portion of the bond is to protect your assets against downturns. We do have defense mechanisms already in place that exceed that with those defensive matrices. Another reason, though, is to smooth out the ride. And for our portfolio and investment philosophy, that truly is one of the key reasons to have those bonds in the portfolio. For those clients that have a lower risk tolerance, if they increase more bond exposure and less equity exposure, they should have a smoother ride getting them where they need to be qualitatively. As long as the quantitative gets you where you need to be, we don't run out of money and you secure that retirement till the end of your days, then we can start looking at the qualitative and what is suitable for you. And if a smoother ride is something you need, then we can utilize these bonds. But what happens if we look at this volatile, as of the last 3 to 5 years, pretty volatile bond market, and these intermediate and long-term bonds, they're not giving you the smoother ride that these clients are looking for. So with that, in order to better smooth out these spikes and drawdowns, the ebbs and flows, the peaks and valleys, we have decided to also go incorporate more ultra short and overall short-term bonds. The short-term bond that we went with was actually a Vanguard fund. Has great exposure, has a great market cap, and one thing we truly loved about it, take a look at the long-term Vanguard drawdown rate, over 30% since inception. Long-term Vanguard, over 100 points, down below 75. That trades like a stock, it feels like. If we take a look at ultra short, it pings between 80 to 75 while earning a respectable coupon. That's the smoothing out we are looking to accomplish. So with that, investment committee has decided that we do reduce the duration of those bonds to get clients that peace of mind of a smoother ride and curtail some of that volatility. So when it comes to the Bank of New York series, we've introduced a small portion of those Vanguard short terms. We did not completely get rid of the intermediate bonds. Again, we want to take advantage of some of those coupon rates. We don't want to be overweighted in them. Some allocations, depending on your level of equity exposure, had what we call the Bank of New York ultra short, BKUI. In addition, if you take a look at anybody in a money market fund or when we are in a defensive position, we do supplement that Dreyfus money market fund with about 20% of Bank of New York ultra short. You can see in the last 6 months, that has a much smoother ride compared to the intermediate Bank of New York aggregate bond fund. Some folks, depending on, again, their asset allocation, some folks had this in the bond allocation that we've had for years, some folks did not. There is an instrument called Bank of New York High Yield. You can see Bank of New York High Yield, while does have the potential to have great returns in fixed income relativity world, it is more volatile and it trades far more like a stock. And the reason for that is the Bank of New York High Yield deals in investing in those lower graded bonds between the Moody's and the Finch and the Standard & Poor's. It deals in the triple Bs. It deals in the triple Bs. Hate to use the word junk bonds. Everybody gets fired up when I use the word junk bonds, but it's how I was classically trained. When you go below that triple B and below, it can be classified in that. Again, it has the potential to have some great returns like a stock return, but is it suitable for our fixed income portfolio? And our investment committee decided that it was not. It does not accomplish all the goals of that fixed income side. If you're looking for returns, then we challenge you to go more equity exposure. Use the tool for the proper purpose. And so with that, we have decided to remove the high yields from our portfolio. Now, if we overlay what Bank of New York High Yield did in comparison to other high yield bonds, it's one of the best. And if you were to absolutely hold my feet to the fire and say, David, pick a Bank of New York High Yield, I would absolutely go to that Bank of New York High Yield amongst many others in the industry. It's a fantastic instrument. My problem is more so the high yield class in and of itself in the fixed income. We just, as the investment committee, it doesn't get our clients where we need to be in terms of smoothing out that ride. So it's not the actual ETF high yield Bank of New York that I have an issue with. It's really the overarching high yield group of instruments. Investment committee, along with myself, again, these are conversations we've been having for years now. It just doesn't have a place in the fixed instrument portion. It's the sector and the nature of high yield that we have an issue with and point of contention in the fixed income portion, not the actual instrument. It's performed very well in recent memory compared to other high yields. Again, just too volatile than we like to see. And so we've discussed the duration of the bond, introducing the Vanguard short term, the reduction of the Bank of New York intermediate, again, spreading it out, having a nice duration. Intermediate has an average duration of 6 years. The short term has a duration of 2 years. That truly smooths out the ride in terms of volatility. We also talked about the removal of high yield. Again, just too much bouncing, acts like a stock. I get that it's not, but again, too volatile for the fixed income portion is the conclusion our investment committee came to. We did introduce a 2%, albeit very small, I admit, a 2% inclusion of gold into every fixed income portfolio. The movements on the bond side were to fight risks that relate to the bonds, the duration, the interest rate. Those types of risks are absolutely accounted for, but one thing the bond market does not account for, as well as gold, is what we call that good old volatility index, called the VIX. Lovingly, it's the fear meter, if you will, to say it in a word. And with that, there's a lot of uncertainty in the market. Gold hedges against that very, very nicely. There's a misconception that gold directly inversely correlates the stock market. Mathematically, it's simply not true. There are periods in the last 40 years where that appears to be the case, but with a sentence, if both of them, the stock market and gold, are at all-time highs, then how do they inversely correlate? The reality is while gold does have some inverse correlations, there are a few of them. The biggest one that we find and focus on is the VIX, volatility, or the fear. When people get scared, people tend to flock to gold. And in this period of uncertainty, and a VIX being relatively high, it feels like the proper move to offset that. It helps smooth out the fixed income portfolio. And if you take a look at the VIX over gold, what you'll find is that anytime the VIX spikes over 25 points, you'll notice a bit of a delayed reaction, but gold tends to climb. When VIX spikes, the gold will have a bit of an upward trajectory before it platforms, not necessarily retreating. Now, to be fair, gold has pulled back heavily. All commodities have. There was simply a dramatic run, much of it justified. In 2025, commodities are holding their own, but with that, with a run, you're gonna have to expect some sort of pullback. We're looking at the gold as a long-term play to fight that volatility index. So when people get nervous and there's pullbacks across the board, we think that gold can offset the fixed income side of things nicely to further help smooth out the ride. Quite frankly, when those intermediate bonds and when the equities are not quite getting it done. We believe that will help clients absorb that risk tolerance, have them be a little more calm and understand the logic behind it. So these are the moves that were made. That's why you received those prospectuses. Again, to folks with a 80 equity allocation, a 100, this is beyond immaterial. We're talking a very small movement on the minority section of your portfolio. But again, we want to be extremely transparent. We believe this is the right move, especially with interest rates coming down as far as they have. Again, remember, as interest rates fall, the price of the bond tends to come up. As interest rates increase, the price of the bond tends to come down. And if we have too long of a duration of 6 years, that moves the needle far more than we feel it should. It doesn't accomplish the goal of smoothing out the ride on the fixed income portion. When it comes to the returns, that's what the equity side is for. When it comes to overall protection, that's why we have the algorithm approach and the mathematical defensive postures that we have. It's important to recognize what the tool is for each portion of our portfolio. When it comes to the fixed income, this will better help us smooth out the ride and prevent that bouncing that many clients that are heavy in fixed income have been seeing. As always, if you have any questions at all, any questions, whether it's finance, whether it is this allocation change, no matter the question, don't hesitate to call your advisor. By all means, we appreciate your business. For those of you technical folks that stuck through this entire video, I appreciate it. You probably have more follow-up questions. Don't hesitate to give me a call direct or your advisor. And I hope you folks have a great week. We'll be in touch soon. Thank you.